Hey, this is Manny Gomes with Guaranteed Rate, and today we're going to answer the question, what happened to mortgage rates? About a couple weeks ago, mortgage rates hit the lowest levels in history. The 30-year rate was super low, 15-year rate was super low, everything was really low. And that created an environment for a lot of people to actually participate and benefit from refinancing. And because, in my opinion, the headlines across the Fox News, CNBC, other publications stated rates are low because of the coronavirus. And because the coronavirus is getting so much attention, people who probably wouldn't have noticed rates are low realize that they're low, and they flooded in and locked in their rates. And that's created the biggest run on mortgage refinancing ever. It ballooned and dwarfed the run on refinancing during the 2000s as rates were heading lower. And because of this unprecedented amount of kind of volume, banks were forced to kind of slow things down by increasing interest rates to not really demotivate borrowers from refinancing, but to control two things. One, operational capacity. Lenders were just overwhelmed operationally. They normally would have X amount of lock volume, X amount of loans they fund per month. That just tripled, quadrupled, went 10 times above their norm, and they just didn't have the operational capacity to handle it. So that was one concern. But then the second concern came when the bond market kind of blew up. All this paper, that we call it paper in our world, but once a lender commits to lock a rate, that means that they have to have the capital in place to offer the financing down the line. And in mortgage world, what tends to happen is we write the loans, we use warehouse lines to fund the loans, we then pool them, securitize them, and then we put them out on Wall Street for bid, for purchase. Then that lands in people's either pension funds, annuities. You as a consumer could purchase a mortgage-backed security and earn the interest rate rather than buying like a treasury from the United States and earning their lower interest rate. So that is how it works. And what has occurred very recently is the market realized how much volume was about to come to them down the line, and the valuation metrics to determine what a portfolio of loans would be worth on the secondary market just got recalculated, and not in a good way. Not in a good way. The inability for the market to absorb as much paper has been coming out has created an environment where lenders are having trouble really pricing out what rates they should be setting for certain loan programs or certain kind of criteria. And as a result, they padded in a buffer so to absorb any potential losses when it comes to securitizing. Now, this has happened in the past. And if you recall, there was many years ago, there was a disconnect between where treasury yields were pricing and where mortgage-backed securities were pricing, because those two do compete for the same investment dollar. And the government stepped in and initiated a quantitative easing program that earmarked funds for the purchase of mortgage-backed securities to help the banks, to allow the banks a place to deliver the loans so they could continue writing loans and help the consumers. I fully expect that is going to happen. I'm not sure when this video is going to be released, but it's either my forecast, or if you're watching this, just know that it was recorded before the government actually initiated this bond buying program earmarked towards mortgage-backed securities. Once that happens, and if that happens, as I say, I believe the liquidity for lenders to have a place to deliver loans will be there, and we will see mortgage rates improve from those levels. So if you have not yet refinanced, the smartest advice I can give you would be to call your lender or myself, if you would, and prepare yourself for when rates come down. That means understand the process, understand the costs, get yourself ready and positioned to take advantage when rates go down. Because when rates decrease and people like kind of swarm in and take advantage of the rates, depending on how much volume occurs in one moment. Sometimes those rates don't stay low for very long, and they kind of increase, and then the opportunity is gone. So if you have any questions on anything here, or just want to have a conversation regarding what the preparation phase for refinance may look like, just feel free to reach out. Thanks so much.